After a huge run-up this year, the semiconductor stock market has finally crashed. If we look at the Philadelphia Semiconductor Index, which started the year from 7,300 points to the peak of 14,600 points, it actually doubled. But from the all-time high till the date of recording, the index has dropped around 20% from the peak. And if you're watching your semiconductor stocks and ETFs turning really bloody red these few days or weeks, it is very normal. And you are not alone, because this has been one of the biggest drawdown after a huge run-up. But here's the thing, before asking if should I buy the dip, I think it's more fundamental question to ask what kind of semiconductor ETFs are out there. In this video, I'll share the factual information about 5 ETFs with exposure to semiconductors and their nuances in different indices, different expense ratios, different domicile areas that you may not have realized until you do deeper research. And by the end of this video, I hope that it can give you some direction to work towards what you really want and what you prefer not to have. But before we look at each ETF, I think I need to briefly explain what is the whole concept behind semiconductors. Semiconductors or chips are the hardware that powers all computers. And as you know, AI needs a lot of computing power for it to work. And the power will come from chips. For example, the Nvidia GPUs. So when a company says that they are spending billions in AI, a lot of that money is actually going to chip companies. And that is why the semiconductor company stocks go up so much during the bull market. But on the other hand, it also means that they will drop really hard when the tide turns. And it is what you're experiencing right now. Especially when people worry that AI spending may trend down or when a cheaper competitor catches up. And that's basically what happened recently. These memory chip makers, they announced huge spending plans to expand their operations, but the market did not take it too favorably. On top of that, a Chinese company reportedly started making its own chip equipment, and that hit chip equipment makers like ASML hard. So let's go into the specifics of these 5 ETFs. And if you are new here, my name is Chris, an ex-chartered accountant, now a personal finance YouTuber, and I do have an Instagram page as well. We only have less than 5,000 followers, so please help a follow out there for some more financial insights. Now let's get to it. ETF number 1, SMH VanEck Semiconductor ETF. This is the most default and the most popular semiconductor ETF out there. It tracks the NVIS US-listed Semiconductor 25 Index, which is the 25 largest US-listed semiconductor companies. The fund size is around 60 billion US dollars, and that is by far the largest fund size on this list that we'll go through today. The fees or the expense ratio is around 0.35% per annum, and the top holdings include your names like Nvidia, TSM, Broadcom, AMD, and Micron. Country exposure-wise, it is only US-listed companies, though some of them are actually foreign companies that are listed in the US. For example, TSM and ASML. And this will be a very similar examples throughout the other ETFs as well. But when I talk about this kind of semiconductor ETF, I think we need to put some nuance into Nvidia. Because Nvidia being one of the top market cap weighted companies, it would generally hold a very large position in all these semiconductor ETFs. And if you look at SMH, the Nvidia allocation is around 20% of the fund, with no cap on the allocation percent. That means when Nvidia stock price gets higher and higher, their allocation in SMH gets higher and higher as well. And if you're already holding the S&P 500 or the Nasdaq 100 ETF, Nvidia is already a large allocation in that ETF. And if you're adding ETFs like SMH, it's going to add a little more exposure to Nvidia being very concentrated position. So you are not actually diversifying, you are concentrating more on that specific sector bet. It's nothing to worry about if that is intentional, but if you don't even know that, then I think you need to really do the analysis to compare. So the pros of SMH is that it has very huge fund size, so it is very liquid, and that means if you want to do option strategy, I think it is the most optimal to do so. Now the cons of SMH is that it only has 25 holdings, which is considered very little. In fact, you can consider it to be very concentrated, not even diversified at all. And Nvidia being a very large holding, you're kind of being intentional to that allocation. Furthermore, it is US domiciled, which means that any distribution will be subjected to 30% dividend withholding tax plus any estate tax exposure. This is applicable to those non-US investors like us in Singapore. So we move on to ETF number 2, which is also SMH, but it is listed in the London Stock Exchange, so it's SMH.London. So what's special about this ETF is that it is the Ireland domiciled UCITS ETF version of the US listed SMH. It tracks a related but different ETF, which is called the Market Vector US listed Semiconductor 10% cap screen index, which applies a 10% cap on any single stock. Fund size is around $8 billion US dollars, so it is relatively huge as well. The fees or the expense ratio is around 0.35% per annum. Country's exposure is a similar US listed company, same as the SMH, but now it is just domiciled in Ireland in a UCITS fund. So one thing about the Nvidia exposure is that compared to the SMH US version, this fund has a cap on 10% on any individual stock. So Nvidia cannot go more than 10%. Which is good if you're worried about holding too much Nvidia and having too much concentration into a specific individual stock. And the other advantage of this fund being a UCITS ETF is that you only suffer a 15% dividend withholding tax and you do not have any estate tax exposure because it is not domiciled in the US, it is domiciled in Ireland. But the cons of this fund is that it is much smaller, 8 billion versus that 60 billion US version, so there is slightly less liquidity. And ultimately, it's still 100% concentrated in US listed companies, so not a worldwide exposure. Moving on to ETF number 3, that is SOXX, SOXX, the iShares Semiconductor ETF. So this ETF holds a broader basket of over 30 US listed semiconductor companies, so there are more holdings than SMH. Fund size is relatively huge at around 40 billion US dollars with an expense ratio of 0.34% per year. Top holdings are similar like AMD, Nvidia, Micron, Broadcom, and Applied Materials. Country exposure-wise, it is also US-listed semiconductor companies, but a quarter of the fund are actually touching international names through these US listings. Now again, on the Nvidia nuance, there is no specific cap, but since this fund holds more names, it is actually more diversified compared to SMH. So this naturally means that Nvidia holds a much smaller allocation and concentration compared to SMH. And you can look at the holdings percentage, Nvidia is actually less than 10%. So it is much less extreme, even though it's still a large allocation. So the thing about SOXX is that it is more diversified, it is less concentrated on one specific stock, and it is also relatively liquid compared to SMH. But the cons of SOXX is that it is still US domiciled, which means you still suffer that US 30% dividend withholding tax plus the estate tax, and it's fundamentally still US exposure. Now, ETF number 4 is SOXQ, which is similar to the SOXX ETF. It's called the Invesco PHLX Semiconductor ETF. It holds the top 30 US listed semiconductor companies, rebalanced quarterly, and the fund size is the smallest on this list at around 2.5 billion US dollars. But here's the main advantage. The expense ratio is only 0.19% per year, which is the cheapest option on this list by a wide margin because previously we are looking at 0.35, 0.34. This is only 0.19%, which is almost half of that. Top holdings will include Nvidia, Broadcom, Micron, Applied Materials, and KLA. Country exposure-wise, it is still fundamentally US. So the main pros of this ETF is the lowest cost option by far, and it has similar exposure to SOXX, but with a much lower fee. So I will consider this SOXQ better than SOXX. But here's the thing, it has a much smaller fund size, which means less liquidity, and that means not so optimal if you want to do some optional strategy on it. The same cons still apply. It is fundamentally US listed domiciled companies, so you still get that 30% dividend withholding tax plus estate tax exposure if you were to hold that long. Now finally, we come to the final ETF, and I must give you a good one, right? So that is SEMI, SCMI, which is the iShares MSCI Global Semiconductor UCITS ETF. Now this is not domiciled in US, it's actually listed in Europe. To be specific, you can buy this ticker on IBKR via the Amsterdam Exchange. So this ETF tracks the MSCI All Country World Index IMI, Semiconductors and Semiconductor Equipment Select ESG Screen Cap Index. So what this index really means is that it has true global semiconductors exposure because it's all country. And the thing is that it holds the semiconductor company stock wherever they are domiciled. So not just those domiciled in the US. And the fund size is around 5.5 billion US dollars with an expense ratio of around 0.35% per year. Top holdings will include Micron, AMD, TSMC Taiwan, Nvidia, and Broadcom. Country exposure-wise, we are 65% US, 14% Taiwan, 7% Japan, followed by Netherlands and South Korea. So regarding the Nvidia allocation again, so this ETF also has capping rules to 10%, and it spreads across countries too. So Nvidia allocation will look much smaller here compared to what you have in SMH and SOXQ. And the real pros of this ETF is mainly the real global exposure, not just US listed companies. If you want to diversify across the world and you want to look beyond US, then this may be the answer. And don't forget, it is Ireland domiciled UCITS ETF, so you only suffer a 15% dividend withholding tax plus no estate tax exposure. And it is accumulating instead of distributing, so your dividends will reinvest automatically without the funds being distributed to you. Now, the cons of this ETF is that despite having that 15% dividend withholding tax treaty rate, they only apply to the US listed company stocks. So non-US listed companies like TSMC or ASML, they may have their own dividend withholding tax rates, depending on which country you come from. And remember, this fund size of 5.5 billion is much smaller than SMH or SOXX. So the bid-ask spread may be a bit wider. But to me, any ETF beyond 100 million, I think it is relatively huge already. And remember, if you want to buy UCITS ETF like this, you need a brokerage with access to London Stock Exchange. And my broker of choice is always Interactive Brokers. And this video is not sponsored, so you can support me by clicking this Interactive Brokers link or scan this IBKR QR code here. It will support me at no additional cost. So thank you to those who have clicked or scanned. So let's compare every fact side by side. Who should go for which kind of ETF? If you want the absolute cheapest fee, the answer is SOXQ at 0.19% per annum. Really beat every other ETF out here at 0.3 something percent per annum. If you want the largest fund, that's going to be SMH, domiciled in the US, and that will be optimal if you want to do some option strategy on it. If you want the lowest single stock concentration with a cap on individual stocks, that will be the SMH.London version and the SEMI Europe version, which has a hard cap on any individual stock ticker names. And most importantly, if you want a UCITS ETF fund structure with lower dividend withholding tax and no estate tax exposure, then you gotta look at the SMH.London or the SEMI ETF in Europe, because they are Ireland domiciled UCITS ETF, which I always push for Singaporeans. So you can see that there's no one perfect answer. Those that are listed in the US, they are bigger fund size, so they are more liquid and may be optimal for some people. Whereas those that are listed in UK or Europe, they are more Ireland domiciled and are more tax efficient compared to those tickers listed in the US. But there's only one ETF out here with the true global diversification, and that is the SEMI ETF. And if you forgot everything I said, don't worry, I already compiled all this data into a cheat sheet that you can download for free on my Ko-fi shop page. Okay, you don't have to pay me any money. You can just download for free, and if you really want to support, you can just scan or click the IBKR link to support the channel. Thank you. So that's the full breakdown of my semiconductor ETF list, all their fees, all their exposure, all their fund sizes, all laid out nicely for you. But I want to be very clear that this is just a factual presentation. I'm not trying to tell you that now is a good time to go all in into semiconductors, because I don't think I can give any prescriptive advice as a non-financial advisor, but I just want you to open your eyes before you just zoom in into a particular ETF, right? There may be some things that you actually miss out or you're not aware of, but after watching this video, you should be more clear in what you really want. And everybody's personal situation is different, right? Some of you may favor this, some of you may favor that. So there's no one-size-fits-all answer. Just choose the one that best fits your financial life. So if you, as a viewer, have any further suggestions on what ETF you want me to compare a particular sector, a particular theme, or particular market, just comment down below, okay? Those good ideas, I'll adapt it and fill it from my next video. And if you want a previous ETF comparison that I did, which is highly relevant to this video, then you can refer to this video right here.